Hey, this is Matt Cox and I'm a con man. I was recently released from federal prison. I was incarcerated for 12 and a half years for bilking some of America's biggest banks out of tens of millions of dollars over the course of about a decade. And in today's video, I'm going to go over how to obtain a mortgage from those same banks. But before we get into all that, do me a favor and subscribe, hit the like button, share the video, leave a comment, and if you can think of anything else that would help boost my subscribers and the views on the videos, do it. Believe it or not, while I was incarcerated for bank fraud, conspiracy to commit bank fraud, wire fraud, mail fraud, passport fraud, aggravated identity theft, and a whole slew of other charges, I was actually hired by the Bureau of Prisons to teach what they call ACE courses, which stands for Adult Continuing Education courses. And they hired me to teach specifically the real estate class. I taught the real estate class in Coleman Federal Prison for 10 years. And one of the classes was actually about how to obtain mortgages from banks. And so essentially, that's this class. The entire class was structured in such a way that I was letting inmates know what they should do to obtain a mortgage as quickly as possible after being released from prison. That's what this video is. It's basically exactly what I taught the inmates. And it's really pretty simple. I mean, I broke it down to some basics. It's just not that hard to obtain a mortgage. It really isn't. Now, obtaining a mortgage that actually gets you into the home that you want or gets you an interest rate that you want, that may be different. You may have unrealistic expectations of what you want. You may be looking at $500,000 houses, and the truth is you can't afford but a $200,000 house. Now, that has nothing to do with obtaining the mortgage for what you qualify for. With that said, I'm going to break this down as quickly as possible, and I'm going to go over the different criteria that you need to obtain those mortgages. And it really breaks down to this. It's 5 things. It's just not that difficult. It's 5 very basic things. One is, of course, credit. I actually just did a video on how to obtain, it wasn't how to obtain 800 credit scores. It was a critique of Graham Stephan's video on how to obtain 800 credit scores. I basically go over how I got out of prison and went to the halfway house and had no credit scores and no credit, and within 6 months I walked out of the halfway house with a I think it was like a 744, 745 credit score, somewhere in that general vicinity. So it was roughly 750, around 750. In fact, I just pulled my credit, I think it was either today or yesterday, and my FICO score was 756. It's just not that hard to build credit and maintain credit and to alter credit. It just takes time and patience. That's all it really takes. Well, time and patience. It just takes patience. So the one thing you're going to need to obtain a mortgage is obviously credit. The minimum credit score you're going to need is a 620, believe it or not. If you have a 620 and you have 3 trade lines, let me explain what a trade line is. A trade line could be a credit card, it could be a car loan, it could be a student loan, it could be a mortgage, it could be a small loan from a bank, it could be a large loan from a bank. Point is each one of those is considered a trade line. A trade line is anything that reports on your credit bureau. So you could have three credit cards and a 620 credit score, and provided you meet all the other criteria, you've met the minimum requirement that the bank needs to lend you a loan. Now, all of this is going to be based on getting a conventional mortgage, by the way. The second criteria you need is equity. I think most people know what equity is, but let me explain real quick. If you have a piece of property that's worth $100,000 and you only owe $70,000 on that property, you have $30,000 in equity. Equity is the difference between what the home is valued at and what you owe the bank or whoever you owe. When it comes to purchasing a property, equity is your down payment. The bank wants you to have a certain amount of equity in the transaction. They want you to have, okay, they want you to have some skin in the game, really. So let's say you're buying a house for $100,000 and you're planning on living in that property, and of course you meet all the other criteria. Then the bank is going to say, we want you to put down 5%. Now, there are other loans, there are FHA loans where you have to put down 3%, but we're not going to get into all that. We're talking about conventional loans. The bank is going to require you to put down 5%. Now, obviously, there used to be 15 years ago, 15 years ago, there were programs where you got 100% financing, okay? And actually some of those programs are coming back, but we're not going to discuss those. We're talking about the type of mortgages that the bulk of Americans obtain. And those are conventional loans. The bank wants you to put down 5% on a piece of property that you're going to live in. That's called an owner-occupied property. So if you're going to live there, then the bank wants you to put 5% down at a minimum. You want to put down 10 or 20 or 30%, they're okay with that too. Now, if you're going to buy a property as an investment property, the bank wants you to put down 20% minimum. So you're talking about putting down 20% on a $100,000 piece of property, that's $20,000. What's important to know about the 5 or 10 or 20% that you're going to put down is that the bank wants that money sourced and seasoned. Let me explain what that means. They want to know where the money is prior to the transaction, and they want to know how long you've had that money. Like, they want to make sure that money's yours. You're not going to believe this, but there are unscrupulous people out there that will actually give a borrower their down payment so that they can obtain the mortgage to purchase their property. And this is something that I've done many times in the past. I had some property, I bought it for $50,000. I put $20,000 in it. I'm trying to sell it for $120,000, $130,000. I'm trying to make 40 or 50 grand. But my borrower, he can qualify for the loan, but he doesn't have his down payment. So I actually would give them their down payment in order for them to obtain the loan from the bank, which is what I really wanted. Now, to keep this type of transaction from happening, what the bank wants is to see where the money's at and know that it's your money. The way they've determined that is that you've had that money in the bank for 60 days. So the bank wants to know, one, that the money's been in your bank at your credit union or wherever it is for over 60 days. That way it's sourced, we know where it is, and it's seasoned. It's been there for over 60 days. Now, there's other ways to get around that. Let's say the money hasn't been there, but you actually just sold your car. Now, if the car was titled in your name and you actually signed it over to somebody and they actually wrote you a check for your down payment, well, you can prove I've owned the car for over 60 days and that's where I got my money for my down payment. That's okay. There are little things like that where you can actually use to show where the money's been, but that actually has to have happened. Like, it's very difficult to forge or fake those types of things, so it's just not worth doing. If you know you're going to buy a house, then put your money in the bank and keep it there. If you know I want to buy a $100,000 house, then put $5,000 in the bank and make sure it stays there. Make sure it's been in the bank for 60 days so that when you buy the house, you can source and season your funds. And if it's more than 5%, let's say it's going to actually be an investment property and it's 20%, then that 20% needs to have been in the bank for 60 days. The third thing that you're going to need is collateral. Obviously, you're borrowing, let's say, $95,000 to buy a $100,000 house. The collateral is the home that you're buying. Obviously, you're getting a mortgage. I know you're thinking, okay, well, duh, I obviously need a house. Well, no, here's the thing about the collateral. Just finding a house doesn't mean you're getting a loan. That doesn't mean you've met that criteria, okay? What that means is this: you've found a piece of property. Is the bank willing to lend on that property? That's another issue. Let me give you an example. You go in and you find this property and you go, wow, I'm buying this house for $100,000, but it needs some work. It's going to be worth $150,000 once I put $10,000 or $15,000 into it. Well, the bank's going to send out an appraiser. Let me explain that. The bank's going to send somebody out who's an appraiser. They're going to look at the house. They're going to go through the house, and if they look at the house and they say, wow, some of the windows are knocked out, and I noticed there's a leak in the roof, and the carpet's torn up. Now, you may say, yeah, that's not a big deal. I'm going to fix all that. But the bank doesn't know that you're going to fix all that. The bank wants that house to be in good condition. So if there's $5,000 or $10,000 or $15,000 worth of what they call deferred maintenance, then the bank's not going to lend you the $95,000 to buy your $100,000 house that's someday going to be worth $150,000, assuming you clean all this crap up. That's just not going to happen. The bank's going to be like, no, absolutely not. No, the seller needs to fix all of this stuff, and then we'll send the appraiser out, and the appraiser will look at it and say, yes, all that stuff is finished. Or maybe you want to go in and fix all that. Now, I don't suggest that at all. That's a mistake to go and fix up somebody else's house that you're buying. That's just stupidity. The point is the bank is not going to lend you money on a house that has $10,000 or $15,000 worth of repairs. They'll be okay with a few hundred. Like if there's a cracked window and there's a couple of light switches that have cracks in them, or little tiny minor things, maybe a faucet doesn't work, the bank's going to be like, that's not a big deal. So we're talking about a couple $100 here, that's no big deal. But if the roof is leaking and the air handler is missing, they're going to have an issue with that. So the house has to be in good shape. The other thing about the collateral is this. If you're buying a property for $100,000 and the bank sends the appraiser out there and the appraiser says, look, based on the other houses that are selling in the general area, your house is only worth $90,000. Now you may say, oh, I know he's asking a lot. Now I'm willing to pay $100,000 because it's in a good school district and it's close to my mom and I'm okay paying a little more. That doesn't mean the bank's okay with lending you 95% of a $100,000 sales price on a piece of property that's worth $90,000. The bank is going to be willing to lend you 95% of $90,000, but not the $100,000 that you're paying. You're basing that decision on an emotional attachment to a property and not reason. Now you may say, hey, but the property's going up or the area's going up and there's all these other reasons that you are factoring in, but it doesn't matter. Currently the property is worth $90,000. That's all the bank cares about. Okay, it's a machine. It's a bureaucracy. It's just a system. It's just smashing these loans out, and they're not making exceptions for you. The other thing that people tend to do is this. They say, well, look, the property, it's worth $150,000, but I'm getting a deal at $100,000. So can you lend me 95% of $150,000? Well, no. If you're buying it for $100,000, we're going to lend you 95% of the $100,000, not the $150,000. Now, if the seller bumps up the sales price to $150,000 and the bank lends you $95,000 and you work out some kind of arrangement where the seller gives you money back, that sounds good, but that's fraud. And people do it all the time. And every time they do it, it's fraud. So I'm just letting you know, you'll hear a lot of realtors and mortgage brokers and your friends and guys saying, oh, it's not a big deal, it happens all the time. Well, I mean, I know, but people sell crack all the time too. It's always illegal. People rob banks all the time. It's always illegal. Just because people do it and get away with it doesn't mean it's not fraud. Don't get wrapped up in it. Find another house. Just do the right thing. Wait a year, refinance it, pull the money out. Put your 5% or your 20% down or whatever it is you're going to put down and buy the house and wait a year and refinance it. The fourth thing that you need is this. You need residential history. You need 2 years residential history. The bank is concerned that one, obviously, you've been somewhere for 2 years. It doesn't have to be the same place. You can live one place for 6 months and one place for 18 months. As long as they can prove you've been somewhere for 2 years and you've been paying your rent. So you've been paying, let's say, $1,000 a month at your apartment complex. You've been there for 5 years. You've never been 30 days late. You're golden. That's exactly what they love that. They love it. You've been in one place for 5 years. You've been paying $1,000 a month. You've never been late. They can call the apartment complex and the apartment complex will verify it. Perfect. That's exactly what they're looking for. Here's the issue. A lot of times people will say, oh, well, I've been at this place for 2 years, but 6 months ago I moved in with my buddy Jim, and I've been sleeping on his couch, and I've been saving money so that I can put money down on the house. Well, how have you been paying Jim? Oh, I paid for some groceries, and I paid the electric bill. Okay, well, you just screwed up because you have a 6-month gap of payment history. That's an issue. If something like that's going to happen, and you're going to sleep on Jim's couch and save money, then pay Jim $500 a month. Something reasonable. Don't write him a check for $200, okay? Because if you were paying $1,000 a month and now you're paying $200, it just looks hinky. The point is, pay Jim $500, $600, $1,000 a month, whatever it is. Pay him whatever it is and let him buy the groceries, let him pay the electric, okay? So that you have a canceled check. You want to pay by check. Don't give him cash. All right? And don't think that the bank's going to accept Jim writing a letter saying, oh no, he's been paying me. He's good. Jim's your buddy. Jim will lie for you. Your mom will lie for you. Your aunt will lie for you. So if you say I was living in my aunt's duplex and I pay her cash every month, but she'll write you a letter. Well, that's not how it works. Bank of America is not taking your aunt's letter. You have to come up with 24 months worth of money orders or 24 months worth of canceled checks showing you've been paying your aunt or your landlady or whoever it is every single month, or it needs to be a property management company. Property management company could be an apartment complex or somebody who manages lots of private owners' properties. Because the way the bank looks at it is this, that a property management company is not going to lie for you. They're not going to say, property management company isn't going to say, oh yeah, he's been paying $1,000 a month at the duplex when you haven't. They're just not going to lie about that, or at least that's what how the bank feels. Now, let's assume you're going to move into a place and the landlady says, oh, you have to pay in cash, by the way. Don't rent there. All right? Just don't. Say, no, I'm not paying you in cash. I'll pay you with a money order. Oh, I don't take money orders. Then we're done. I'll find someplace else. The thing is, you have to know going in that someday you're going to have to prove that you've been paying your rent. Don't think to yourself, oh, that's years away. No, it's probably not years away. It's probably going to sneak up on you pretty quickly. If you're going to go rent from somebody, pay $500 or $1,000, whatever, with a money order or a check. Or make sure it's a property management company. And don't take the landlady's, oh yeah, I'm a property management company. Are you incorporated? Because that's what you're going to need. Just be smart about it. Know that at some point you're going to have to provide 24 months worth of history. And you can't be 30 days late. So if make sure you pay on time. Don't think you're gonna, oh yeah, I'm just not gonna pay this month and I'll catch up next month. Okay, well, every time you do that, you push your potential mortgage off that much further. All right, they don't want 30-day lates. There's no reason for you to be 30 days. If you're 30 days late on your rent, you shouldn't be getting a mortgage. Let's move on. The fifth thing you're gonna need is 2 years employment. Now, you don't have to have been employed by the same employer for 2 years. You can have worked, let's say, for 3 years with Walmart, all right? But 6 months ago, you quit Walmart and you got a job working for Tire Kingdom, all right? And now you've got good credit, you've got your down payment, you've got a decent property, you've been paying your rent on time and you can prove it, and now you're ready to buy a house. All right? So you've been on your job for 2 years and you can prove that you've been on your job. You meet all the criteria and you're ready to buy a house. You're ready to move in. Simply having a job isn't enough. There's some things you need to be considerate of. One of those things is, have you been in the same job field for 2 years? All right? If you worked as a circus performer for 18 months, and then you said, you know what, this circus, I don't want to be in entertainment anymore. I'm done with that. I'm done with being a clown. I'm tired of putting on the makeup. It's difficult to get into that little tiny car and drive around. It's just too hard for me. I'm tired of it. I'm getting older. My back hurts. Whatever. I'm going to go get a job at Walmart. And you go get your job at Walmart. Now you think, hey, it's okay, I was making $50,000 a year as a circus clown, and now I work at Walmart as a cashier, but I still make $50,000 at Walmart. Look, the point is this, is that they're going to say, those are different job fields. That's an issue. If you were in management in the circus, and then you got a job at Walmart as a manager, well, you were in management in both of those jobs, all right? So you were a manager. You've been a manager for 2 years. You make about $50,000. Provided you didn't take some kind of a dip in your income, you should be fine. Like if you were making $50,000 at the circus and then you went and worked at Walmart and you're making $24,000, well, that's an issue. The bank's going to be like, oh, what's this guy doing? He didn't even make a lateral move. He took a cut. They're going to have an issue with that. It's going to require some explaining. And you may or may not get the loan. Probably not. The other issue is what's called DTI. If you're making $5,000 a month, all right, and your credit cards are a few hundred and your car payment is a few hundred, and now your new mortgage payment is going to be $1,000 or so, you have to add up your mortgage payment, your car payment, your credit card payments, anything that shows up on your credit report. You have to add all of those up and you have to divide it by your gross income monthly. That number on a conventional loan cannot be higher than 36%. Does that make sense? Look, let's say you're making $1,000. If you're making $1,000 a month, which is obviously ridiculous, you're probably living on the street. But let's say you're making $1,000 a month. All of your bills, including your new mortgage payment, cannot come to more than $360 is what it boils down to. So if you're making $5,000 a month, all of your bills cannot come to more than 36% of $5,000. I don't have a calculator in front of me. I'm not doing the calculation. I'm going to assume that that comes to, I don't know, what is that? 15, probably around a little less than 2,000. So all of your bills cannot come to more than roughly $2,000 because you only make $5,000 a month. 36% or less. Obviously, the issue is you have to kind of figure out where you're going to fall in that range. Like, where is your new mortgage payment going to fall? Because you don't want to drive around looking at $500,000 houses when you can only afford a $250,000 house. And you don't want to go and you don't want to rely on kind of a guesstimate like, oh no, I can afford it. Okay, well, you thinking you can afford it, doing it in your head, and the actual calculation on paper when you walk in the bank is vastly different. You can look at that loan officer and say, no, it's okay, I can afford it. And he's going to be like, you can't afford it. I can tell you right now you can't afford it. You may be able to scrape together money here and there, and maybe you'll wash cars on the weekend, and maybe you'll paint some houses, but we're not lending money based on I can save money and put extra money, into the house and make my payment. That's not the way this works. We can't base it. We can't base our decision on a maybe. We need to know where that money's coming from. And saying, oh no, it's okay, I'm going to get a part-time job, or I'm going to start painting houses on the weekend. Stop it. We're going based on the last 2 years' history, your work history, and what you've made. That's what they're going to go on. So be reasonable when you're looking at a property. All right? Figure out what the mortgage is going to be roughly, and don't look outside of that range. All right? It's a waste of the realtor's time, the homeowner's time, the lender's time. Be reasonable. So let's recap. All right, first of all, you need a 620 credit score and 3 trade lines. That's your first criteria. Your second criteria is you need a down payment. You need to be able to source and season that down payment. The third thing that you need is collateral. The property that you're buying needs to be worth it, and it needs to be in good shape. The fourth thing that you need is your residential history. You need to be able to prove that you've been at a certain location and you've been paying your rent on time for the last 2 years. The fifth thing that you need is a job. And you need to make enough money to qualify you for the loan to purchase the property that you want. You have to be reasonable. You have to be reasonable, and you have to think about the long game. I was teaching all of this to guys that were getting out of prison and going into the halfway house. And I can't tell you how many guys wrote me letters back years later telling me they bought houses. Like, I did everything you said, and I got a house, and I got a mortgage on the house from this bank or that bank. It worked out just like you said. I owned a mortgage company for years, all right, which is part of how I got in trouble. My point is this. When the time finally comes and you walk into a bank and you sit down with a loan officer and you apply for the mortgage for your dream house, you want to be able to say, you can pull my credit with confidence. They pull your credit, they come back and they go, oh, you have 730 credit scores. And you've got two or three credit cards and you've got a car loan. You're great. You meet the criteria as far as credit's concerned. And then you say, oh, by the way, here are my 2 bank statements showing that I have my 5% down payment in Bank of America or wherever or my credit union, wherever that money is. And they go, oh, and they look at it and they go, oh, good, you do. You've had it for 2 months. That's great. You meet that criteria. And then you say, listen, I've been through the house. It's in great shape. All the houses around it are selling for the same, if not more. So I feel great. You can go ahead and order the appraisal because they're going to ask you for like $400 to order the appraisal. So you can confidently say, here's the $400 to order the appraisal because you know that house is worth the $300,000 that you're trying to buy it for. And it's in good shape. You didn't walk through it and there were windows knocked out and the roof was leaking. Because when you walked through those houses and you were looking for this house, you knew all these things were coming. So when you walk through a house and the realtor or the seller was like, oh yeah, the roof's leaking, but I'll give you a deal on, I'll cut a couple thousand off the purchase price. Well, that's not going to help at the bank because the appraiser is going to come through and see this big hole or this drywall in the puddle of water on the ground, and he's not going to be okay. It's not going to pass. It's not going to work out when I go to the bank. So take all that into consideration. When the loan officer says, hey, listen, I need to know where you've been renting, you can say, I've been renting here for 18 months, and before that I was somewhere else for 2 years. Here is my landlord's name, and here's my current landlady's name. And they go, oh, you weren't renting from an apartment complex? And you go, no, this was a quadplex, and then I was renting here. I rent a house right now. And they go, oh, wow, is it a property management company? You go, no, it's a private owner. And he goes, wow, how have you been paying your rent? And you say, oh, I always pay by check, and here are my canceled checks. And he goes, wow, oh, how many do you have? You go, I have 24. Perfect. I have January, February, March, April, May, for 2 years straight. Perfect. And when he says to you, listen, I need to know that you make enough money. Where have you been working? And you say, oh, I currently work for wherever you work. I work for this construction company, or I work for Arthur Anderson, or I work for whoever you work for. And they go, okay, great. Well, one of the things they're going to do, obviously, is they want to be able to prove you make the money that you make. So you're going to have to give them 2 years W-2s and your last 2 pay stubs, right? And you need to know, and he needs to know, that you make enough money to qualify for this house. So prior to going in, obviously, you need to have done those calculations. What's important is to always be keeping these things in mind as you go through life. And it will make things so much easier when you get to the point where you want to buy a home. That's what it boils down to, is that if you do these little tiny things, you'll know that at some point I'm going to need this. And they're not extremely difficult criteria to meet. The problem is you need to stick with it. Hopefully this video helped. I'm hoping that I simplified it in such a way that it was easy to understand. If I didn't, do me a favor and let me know. I can always redo the video at a later date. If you like the video, do me a favor, subscribe, hit the like button, share it with your friends, leave a comment, and give me any suggestions that you can think of for other videos. I read all the comments, I respond to everybody. See ya.